All right, so let's begin the show. There are plethora of funds available in the market to invest your hard-earned money in, but how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help you navigate through this? We have Nisreen Mamaji, CFP, Moneyworks Financial Services today with us. Also, do not forget to send across your questions on our WhatsApp number, which is 865-797-4571. You can also email us your questions on the Money Show at etnow.tv. Hi, Nisreen. Good evening and welcome to the show. And let's get connected with our viewers. We'll be taking Biju's question first. And he wants to know what exactly is systematic withdrawal plan. And he would like to invest 50 lakhs in 3 funds. And he wants to withdraw 35,000 each from these funds after 1 year for 20 plus years. Okay. And he wants to understand for this particular strategy, should he be having a portfolio which is a mix of large, mid cap and small cap? And also, if you can suggest some funds for this particular investment, and that's what it is: 50 lakhs, 3 mutual funds, and SWP after 1 year for 20 years. Although we still don't know the amount required every month. That 35,000. Okay, sorry, 35,000 is the amount that he needs every month. Yeah. So how can he go about it?
Sure. So what what we would recommend to him is that basically you are starting only 1 year before your withdrawal starts. So we'd rather do a very rational, a very sensible approach to the entire planning. So what we recommend is that the first years and the second year's withdrawals, we invested in something called an equity savings product, which has a minimum of equity in it. So we have recommended ICICI Prudential Equity Savings Fund, which has about 11 to 15% of equity, about 45 to 50% of arbitrage, and the rest in bonds. So that is a very good, safe strategy for year 1 and year 2. For year 3 and 4, we recommend a balance advantage category, which has a slightly higher component of equity, stretching to about 35 to 40%, 20 to 25% in arbitrage, and again about 35% in bonds. Here we recommend HDFC Balance Advantage Fund, which typically has a higher component of equity, at least 40 to 50%, thereby managing, because we will be withdrawing from the BAF, from the Balance Advantage Fund in, year 3. Because first year, we are just going to stay put. Years 2 and year 3, we're going to withdraw from equity savings. So typically from the year 4 onwards, we will start withdrawing from the Balance Advantage category. Thereafter, because you'll already be in the market for about 5 years. First year, we're going to stay dormant, and the next 4 years, we're going to withdraw from the dynamic asset allocation funds. There, we can do a mix of large cap and say multi-cap funds. We can do a 50-50 strategy. We recommend the Nippon India large cap fund and the Mahindra Manulife multi-cap fund. So it will be about 8,60,000 for year 1 and 2, 9,50,000 for year 3 and 4, and 31,90,000 then onwards. So what we are suggesting, probably we are forecasting or predicting that in the first year, your returns will be about, say, 12.5%. So your corpus from 50 lakhs will then become 56 lakh 25,000. And you will be able to comfortably withdraw 35,000 per month, which we would suggest that you increase this every year by 5% to keep up with inflation. Because right now, what is 35,000 is not the same as 10 years down the line. So every year, your SWP or your withdrawal plan will increase by 5% per month, and of course, per annum. And by following this strategy for about 20 years, at the end of that term, you'll still have about 1.2 crores in the corpus. Now, your question was, what is SWP? So SWP stands for Systematic Withdrawal Plan, where we fix the amount of 35,000 per month on the certain date of the month, which could be 5th, 10th, 12th, whatever you choose. So on that particular date, the capital and profit, either of the two, there's a combination of the two, will be withdrawn and given to you. So when the markets are down, it's possible that you're withdrawing from capital. And when the markets are higher, obviously it will be capital appreciation plus profits. So by following this strategy, we will ensure that you are not withdrawing from the profits or from the capital appreciation only, and not touching your base capital, which is 50 lakhs. So that is why we've suggested a very safe strategy: equity savings for the first 2 years, BAF for the balance 2 years, and after that only in 100% equity funds. So we hope the strategy will work and you will not be withdrawing capital, but only enjoying the capital appreciation.
All right, so quite a detailed solution for Biju's question. But then let's quickly move on to Karthikeyan's question now, Nisreen. He's a first-time mutual fund investor and he's 36 years old, and he wants you to suggest his first fund, especially for post-retirement corpus. He's looking for a retirement financial plan, and he wants to start his investment with the SIP of rupees 20,000, and for that he wants a fund mix from you. Although we still don't have 5 crores.
He wants 5 crores,
Um,
yeah.
5 crores, yeah. 5 crores is something that he's looking at for post retirement. Yeah.
So here we recommend, kind of a comprehensive asset allocation. So we will suggest to him a flexi cap fund where we're suggesting Parag Parik flexi cap fund 5,000 rupees. Then we suggest an opportunistic fund. So ICICI Pro India opportunities for 5,000 rupees. Nippon India Growth Fund, a mid cap fund for 5,000 rupees. And Franklin India Smaller Companies Fund 5,000 rupees. At least 24 years left to retire. Presumably you'll retire at the age of 60. So therefore, we've taken a slightly more aggressive asset allocation where 50%, and more is into mid and small cap funds. So if we predict that your CAGR, your compounded annualized growth rate over a period of time of 20 years is about 15%, in that case, your corpus will be 5.5 crores. So this is what we would suggest you to go slightly more aggressive because your tenure is higher. You're only 36 and you're looking forward to nearly 24 years of accumulation phase. And then once you retire, your deferment phase will start. So I think that you will easily be able to meet your goal of 5 crores. And at 15% expected growth rate, it will be at least 5.55 crores. So congratulations on your query and for starting in your 30s. And we've recommended a pretty much comprehensive asset allocation to you. Equally 5,000 rupees in these 4 funds.
All right, let's move on to our next query, which is from Madhab. All right, so Nisreen, Madhab says that he's been investing 30,000 rupees in mutual funds. He's got Mira Asset Large Cap, Parag Parik Flexi Cap. He's also got Nippon India Growth, Franklin India, HDFC Mid Cap Opportunity, ICICI Pru Value Discovery, and he wants to invest for 20 years. And he wants you to check his schemes. So he's investing 6,000 in Mira Asset Large Cap, 10,000 in Parag Parik, and 5,000 in HDFC Mid Cap, 5,000 in Nippon India Small Cap, and 4,000 in ICICI Value Discovery. He wants to invest for 20 years, and 30,000 is the amount. I still don't have the corpus that he is looking at after 20 years. But then so far, how do you think is the fund mix?
So actually, I'm quite impressed with Madhav's fund mix. He's done a great job, probably watching the show and, taking advice from multiple planners like myself. So congratulations on that, Madhav. We would like you to only change one fund, which is from the Mirae Asset Large Cap. We recommend that you go in for the Nippon India Large Cap Fund. Okay, so because the Mirae has not been performing that well. So there's only one change to be done. You can stop the Mirae Asset Large Cap Fund. Don't need to redeem it and book your, you'll have to pay taxes if you book your profits, however marginal. But stop the SIP and restart into Nippon India Large Cap. Parag Parik Flexi Cap is doing very well. HDFC Mid Cap is a good. Nippon India Small Cap and I2 Value Discovery. Your asset allocation is also fairly balanced. So, there is no change for that. If you continue to invest this 20,000, 30,000 rupees over these funds for the next 20 years, at an expected growth rate of about 15%, you will have a corpus of 4.5 crores at the end of 20 years at 15% CAGR. So, all the very best to you and, do continue to invest and don't stop your SIPs.
That's important for everyone, not to stop the SIPs and not to actually get perturbed by the market volatility that everyone is witnessing right now. We are answering your portfolio related queries, and with me I have Nisreen Mamaji, who is doing live financial planning for our viewers today. Nisreen, welcome back, and let's continue. We will take Varun Kumar's question now, and a very interesting question. Varun he wants to understand the difference between Nifty Midcap 150 Quality and Nifty Midcap 150 Momentum 50 Index Fund. And if one has a long-term perspective or time horizon, which should be better, and what kind of percentage in the portfolio or exposure ratio in the portfolio should be allocated to an index fund? A very interesting question, and we've been talking about active versus passive. In fact, it's the right way to call it would be active plus passive strategy. So if one really wants to have a financial portfolio where one has active plus passive, what are the categories one can go passive with, or maybe have an index fund, and what categories you think people can look at active strategies where there is a chance to earn more alpha?
So I think the question was regarding the quality and momentum funds. Can you just quickly repeat that?
Yes, that is the question. But then I just want to know the general portfolio allocation, if at all one wants to have an active plus passive strategy. So we'll go back on Varun's question later, but just for a basic understanding.
Okay, so basically, the active funds are the ones which are actively managed by the fund manager, and so you might find some alpha or some overperformance in an actively managed fund. And an index fund typically will just mirror the index. So you will also find funds which will select from the index, and those will be, say, the quality or the momentum stocks. But typically, if you just blindly follow an index, whether it is the 50 or the 150 or the 200, then there is no. That's a very passive strategy, and whatever the index returns would be, you would be eligible for that. Having said that, that is a lower cost product as well, because there is no active fund management. Obviously, the cost of managing the fund is lower. So if you are going to be a little, conscious of cost, then of course an index fund is very well suited to you. But if you want to be a little more active, participate in an active management style, also perhaps get a slightly higher return on that over a longer period, slightly more aggressive stand, your risk profile is slightly more aggressive, then you could be going for an actively managed fund compared to a passively managed fund. So that's the broad difference between active and passive. Now, the question is regarding quality and momentum funds in typical, which the viewer has asked for. So the Nifty Midcap 150 Quality 50 Index includes the top 50 companies from the parent Nifty Midcap 150 Index. And these are selected on the basis of, the financial leverage, except for financial services companies, the earnings per share, the growth variability of each stock analyzed during the 5 financial years prior. And what the fund recommendations would be basically DSP and UTI both have a 50 index quality mutual fund. And their returns are also more or less similar. The 1-year returns are about 22%. There is no data for a higher term, but this is what it would be. Now, if you're looking for a momentum 50 index, also in the mid-cap space, basically this is tracked, the performance of the top 50 companies within the Nifty Midcap 150. They are selected based on the normalized momentum score. Now, this is determined by each company based on its 6-month or 12-month price return, which is adjusted for volatility. Now, stock weights are based on a combination of the stock's normalized momentum score and its free float market cap. So the 2 recommended funds in this category would be Edelweiss and Tata AMC. They both have momentum 50 funds, and both their returns are about 60%. So either of those 2 could be chosen. Now, if you want to know the difference between quality and momentum, basically, which are you an ideal investor for? So quality mid-cap ETF typically invests in mid-cap stocks that are considered to have very strong fundamentals, stable earnings, low debt, and a track record of profitability. These companies will exhibit traits such as high return on equity or consistent earnings growth and have very strong cash flow generations. But a momentum mid-cap 50, on the other hand, would follow a momentum-based strategy. So it would invest in stocks that have exhibited very strong recent performance relative to the market or the peers. So momentum investors believe that stocks have performed well in the recent past, and they're very likely to continue the upward trajectory in the near future, because of, investor sentiment, positive news, or strong earning report. So here you're looking at, the recency bias kind of when you're looking at a momentum stock. So in summary, quality and momentum mid-cap ETFs focus both on mid-cap stocks, but they employ very different strategies. So while a quality mid-cap investor would be looking at strong fundamentals and stability, a momentum mid-cap investor would be looking at the recent price momentum. So you have to decide, depending on your own risk profile and the investment horizon that you choose, what would be the better choice for you. And typically, in anyways, the mid-cap selection should not in your portfolio exceed, say, 15 to 20% if your tenure is at least 15 to 20 years. So you have to, with a great amount of care, create the asset allocation. And in the mid-cap space, you could select either the quality or the momentum, depending on what you are looking at, your investment horizon and your own risk profile. But make sure that you don't exceed 15% of the entire portfolio.
All right, that's quite an elaborate answer. But then, through Varun's question, I hope all those investors or our viewers, especially confused about having a passive or a active strategy across market caps, would be solved. I think I have time for one more question, Nisreen, and let's take Mallikarjun's question. And he says that he's 41 years old, and he wants to know if he can redeem / switch his money from the funds that he's been investing. He's got a financial goal lined up for himself, which is children's education, graduation, higher education, their settlement, marriage, etc. 15 years time frame for that. And currently he's doing an SIP in PGM India Flexi Cap, PGM India Mid Cap Opportunity, SBI focused. He's investing 45,000 per month, and he's got a list of mutual funds. I'm sure that's all flashing on the screen and you have the details, so I won't speak them out. But then, okay, few funds are underperforming, and he wants to know as if...
He's mentioned the
Sure.
PGM, SIC cap, PGM mid-cap opportunity and SBI focus
These
equity are
funds,
underperforming.
they are underperforming. Apart from that, he has a blue chip from Canara Becco. He has Quant Mid Cap, UTI Nifty 50 Index, Motilal Mid Cap, Nippon India Growth, Nippon India Small Cap, SBI Small Cap, SBI Mid Cap, Kotak Emerging Equity, Kotak Blue Chip, Tata Balance Advantage, Mid Asset Large and Mid Cap. So that's the fund mix so far, and specifically wants to know about those three underperforming, and then later on we can also filter out the rest of the funds in his portfolio which are too much, I guess.
So basically, PGM Flexi, PGM Midcap and SBI Focused are not underperforming their peers. So I don't know on what basis, he's mentioned that. If they are underperforming the rest of his, portfolio over a specific period of time, maybe that is what he has noticed. But actually, they're very good funds. But nevertheless, if you would like to, concise the portfolio, because it's a very large portfolio as of now, there are too many funds.
Good
so
point.
what you could be looking at, it could be
so that's a very good point, Nisreen. That's a very good point, because we should also be able to understand underperformance. He's saying that he invested in Feb 2022. The fund categories don't seem to be, on the downtrend, the kind of funds he has. But then how do you actually understand what is underperformance, and how do you think your fund is underperforming? What are the criteria based on which one can understand this, Nisreen?
So basically, see, if you are an equity investor, one thing is that you have to be invested for the long haul. So every year you can't, analyze and make fundamental changes, because especially in a mid cap, if the fund manager has taken a certain call, which will be taking fruit at least 3 to 5 years later, but you have already sold it in the first year only, maybe at a loss, then you will never discover the value. So you have to have patience, if you are an equity investor, and you take a review of your portfolio once in 3 years, not every 12 months or 14 months, because the portfolio hasn't had a chance only to perform. And frankly, PGM Flexi, PGM Midcap and SBI Focus are excellent funds in their categories. So those definitely you should hold on. But overall, your portfolio is too much diversification in terms of number of funds and also in categories. So you should be having, you're a long-term investor, say you're 41, you'll invest for the next 15 years. have about 5 categories, not more than that. So you will have like a mid and small category, say about 15 to 20%. You have a flexi or a multi-category about 25%. You should also have a shorter term requirement, which is a balance advantage or an equity savings, because you never know in the next 15 years, you might have a shorter term requirement, which you are not predicting today. So 10% at least you should keep it in that. Then you can also have some amount of thematic funds. You can take a call on, say, infrastructure. You can take a call on value. You already have, I think, you don't have a value fund. So you can take, a certain thematic call, an India Opportunity Fund, an infrastructure, or a thematic fund of funds, something like that, to be a little more aggressive, say about 50% of the portfolio. So you can realign the entire portfolio. You can continue with Canada Robeco Blue Chip Equity, Quant Mid Cap, UTI Nifty 50 Index also, and the Motilal Mid Cap. So between Quant and Motilal and PGIM Mid Cap, now you have 3 funds in the mid cap space. So bring it down to only 1 fund, okay?
Sure.
Similarly, with the small cap, you have also got SBI Mid Cap. So you've got 4 funds in the mid cap. So overall, I think in the large and mid or flexi cap, bring your proportion to about 25%, and similarly to what I've said earlier.
Consolidate your portfolio is the word for you, Mallikarjun. Thank you so much, Nisreen, for being on the show and helping our viewers with their financial portfolio queries today. And it's a wrap on the Money Show as well. But then I'm going to leave you with our WhatsApp number and email ID where we keep waiting for your questions. Thank you so much for watching. Goodbye.
If you like this video, then like, share and subscribe to ET Now.